well, so I'll keep my comments relatively short to begin with. Europe is a bit of an enigma, really, in terms of how it's structured itself and its long period of gradual integration, really, in the post-war environment. And to many people, it was always doomed to fail, because you've got all of these different countries with very, very different cultures, different ways of doing things, but they are bound together by a very similar history. But the problems that we're seeing at the moment really raise, I think, some of the obvious tensions that you get when in the Eurozone you've got 17 different countries trying to come to some form of compromise. Remember, many of those countries are being represented by people whose own positions are very fragile. They have their own political constituencies to deal with, and in many cases they're in coalitions where you have many different interested groups. Then, of course, you have the context of the European Union, which is 27 countries. And when you start to think about how many people there are and how many different perspectives there are, it's pretty understandable that it's quite difficult to come to compromises which keep the whole thing together and satisfy the demands, in particular of financial markets, which always want quick and clear and concise solutions and certainty. One of the things that I find going to the US is this perpetual sort of frustration with the length of time it takes to do anything in Europe. And someone sent me a few figures which I'll share with you, which is just an interesting way of thinking about it. The Pythagorean theorem was 24 words. Archimedes' principle, 67 words. The Ten Commandments, 179 words, I'm told. That's right. The Gettysburg Address was 286 words, and then the great US Declaration of Independence was 1,300 words. The entire US Constitution, and that includes all its 27 amendments, 7,818 words, and then EU regulations on the sale of cabbages, 26,911 words, which says it all, really. And one of the problems that Europe has is this very, very complex bureaucracy which has been built up to ensure that there is stability. And Europe ultimately is about stability, if not rapid progress. So what are the things that are wrong or that have got us to where we are at the moment? Well, one of them is this inherent cumbersome structure, which is very bureaucratic and also, as I said, involves a huge number of different parties trying to find ways of horse trading with each other and creating compromises. But there are some important underlying structural problems as well. Europe's population is aging, so its age dependency is increasing. There's a larger proportion, of course, of dependent pensioners who have been promised pensions that are increasingly unaffordable. And of course, Europe has grown up, and proudly so, with a very strong tradition of social welfare support, which has been a great part of what makes Europe special, but again, in the current environment, is becoming increasingly unaffordable. There are also some major structural impediments to growth in Europe, which you don't see in other places, like, for example, the US, or even some of those outside of the euro area, like the UK. And these structural impediments in particular relate to things like very, very heavily regulated labour laws, retail hour laws, and many other things like that, which mean that you have very high structural levels of unemployment. Just to give you an example, at the moment, as you know, the US economy is under significant distress. It's growing well below its long-term trend. Unemployment now is 8%, just a little over, and that's causing immense problems and complexities. But Spain, in the middle of its greatest post-war boom, saw unemployment troughing at 8%. So it gives you, again, some sense of the differences here. One of the reasons for that is that you have these great structural impediments, inflexibilities in the labour market, which some countries are now trying to address. You also, of course, have big trade imbalances across Europe. What does that mean? That means that basically Germany is selling loads and loads of products to other Europeans, and many of these other Europeans are not selling as much products in return. And for a long time that worked okay because you had a sort of a vendor financing system going on. Germany built up huge savings during the last 10 years. It didn't have enough things to do with those savings domestically, so it effectively lent money to banks and other countries around Europe, particularly Spain, Portugal, Italy and elsewhere, and under the benefits of very low interest rates, which came through after the euro started, people began to borrow lots of money and basically consume German goods. So Germany built up huge current account surpluses or trade surpluses with other countries, and that's left a situation where there are many meaningful competitive differences, so that Germany is now growing quite strongly, whereas at the other end of the scale you've got countries like Spain and Italy that are going through deep recessions. On top of that, you've got, of course, this major debt crisis, which you will all know a lot about. It's extremely complicated, but you have some countries that have built up huge amounts of debt over many, many years, like, for example, Italy, which has a gross debt to GDP of something like 140%. You have other countries that haven't built up huge amounts of debt in previous decades, but are now spending much more than they're actually earning. Spain is a very good example of that. It has a very big budget deficit. In other words, it's needing to borrow lots of money to sustain government spending. And then you have others that have big current account deficits. They're buying too many things relative to the things that they're actually selling. At the worst end of the extreme, of course, you have Greece, which has all of those. It has huge gross debt to GDP, has a very big budget deficit, has a very big current account deficit, and it has very little industry. It imports most of its energy, most of its food, so it's not really very sustainable outside of the euro. And even with the recent threats of leaving, in reality, its life outside of the euro area would probably be even worse than it currently is under these strict austerity programs. So those are all the problems. But it's not all bad news, because there are some important positives that Europe has. One of them is that Europe as a single economy is the biggest economy in the world. It has a very stable currency. It has very, very stable inflation. Recently we had Trichet, the ex-governor of the ECB, the first governor of the ECB, speak at a conference at Goldman Sachs, and he was really emphasizing the extent to which people are taking a far too short a perspective here, because the central bank, in his view, has been amazingly successful. It set out to maintain the real value of the exchange rate, to maintain the real level of people's savings in Europe, which it's done. Despite all of the criticisms, the euro has held its value over the last 10 years. And the other part of its mandate is to be keeping prices stable, keeping inflation at around 2%, and that's exactly what's happened in the euro area as a whole over the last 10 years. So in his view, what's wrong? Why are people so concerned? They've done what they've been set out to do. The other thing I think it's important to put into some perspective here is that while there is a lot of commentary about the debt problem in Europe, in aggregate, Europe doesn't really have a dramatic debt problem. So if you look, for example, at the gross debt to GDP of the whole Eurozone area together, it's a lot smaller than it is, for example, in the US or, for that matter, Japan. So the gross debt to GDP in the whole of the Eurozone area is around 70%. In the US, it's a little over 100%. In Japan, it's nearly 200%. Equally, if you look at budget deficits, so in other words, how much current spending governments are doing relative to what they are receiving in taxes and so on, overall, it's not that bad. It's around 3% of GDP. Again, that's much lower than, for example, the US, which is around 6%, or the UK, which is at around 7%. So again, when you look at it overall, you begin to think, well, maybe it isn't actually that bad. Yes, it's got some long-term challenges with an aging population. It has major challenges in terms of restructuring economies to liberalize markets and generate growth and opportunities. But overall debt is not the problem. The problem really is a political one, and it goes back to my comments right at the start. If you got a bunch of economists around the table, of course the typical joke is you get, two economists, you have three answers, but you could very easily find a solution to the problems in Europe in terms of its debt. The problem is not an economic one, it's a political one. It's about the sharing of the debt and the lack of the institutional framework to deal with those transfers. So if you think about the US, for example, it's often the case that you get strong growth in, let's say New York, very, very low growth in Mississippi, just as you get strong growth in Germany and no growth or recession in Greece. You've often had states in the United States that have defaulted or effectively gone bankrupt. California, one of the richest parts of the world, is actually in that situation in some ways at the moment. But no one seems to worry. No one worries because no one thinks that one state is going to leave the United States or that the currency would break up. And the only problem that Europe is really facing at the moment is the lack of a convincing framework to hold these currencies together and institutional governance to persuade investors and people that there is no alternative, that it is literally one continent. Now, many people realised that this was a problem more than a decade ago, before the euro actually started, and somewhat fortunately, I guess, the UK government took that view. The line that the UK took, and many economists took, was that you can work towards a currency union, but if you only have a currency union, you have one currency, and therefore by definition one interest rate, you're always going to have a free rider problem unless you have external control of fiscal policy, of people spending. Because in a normal world, if you overspend, there is some cost of that. Your interest rates go up, the cost of your borrowing goes up, you have to spend less, you have to adjust. But in the world that we've been in the last 10 years or so, that hasn't happened at all. The Germans recognised this problem at the outset, but there was a degree of politique real, if you like, about this. They all recognised, I think, political leaders, that to force fiscal union on the people of Europe 10 or 12 years ago would not have flown, because fiscal union implies a loss of sovereignty. As soon as you have a single fiscal policy, somebody who sits above government's budgets and tells you what you can spend and what you can spend it on, that literally undermines national sovereignty, and that's something that people don't give up very easily. And so, as fate would have it, they kind of took the view that fate had conspired to allow a single currency to develop at that stage in time, but not a full fiscal union. The Germans, though, were uncomfortable, and they insisted at the time, after the so-called Maastricht Treaty was signed and the Maastricht criteria were met, enabling countries to sign up to the single currency, they recognised that this was putting them in some danger fiscally. And so they insisted on an adjunct, an amendment to the Maastricht criteria, which was called the Growth and Stability Pact. This wasn't legally, constitutionally agreed, but it was a sort of gentleman's agreement where governments signed up in principle to the idea that they would behave themselves, that they wouldn't overspend, they wouldn't allow their budget deficits to rise above 3% of GDP, and they'd all live happily ever after. Unfortunately, again, as fate would have it, the first country to break this fiscal stability and growth pact was Germany itself, after the collapse of the technology bubble in the late 1990s. So it went into a deep recession, Germany. Its spending its government spending increased relative to GDP. It broke the pact. And the second country to do it, ironically, was France. And once France and Germany had broken this sort of gentleman's agreement, it was kind of fair game for everyone else. So now what we're doing is essentially getting back to that same point where countries are trying to find compromises which they can live with to get these fiscal oversights put in place. The problem is that, in effect, it's a very complex form of game theory. You have several players, all of them are bound together in a game, and all of them want the same end point, which is to stay in the euro, because each player, each country, has a good reason to stay in the euro. But they're all incentivized to hold out for as long as possible to extract the best possible terms when a deal is finally done. So for Germany, which is the biggest creditor, it's got the savings, it's got the money, it's got the very strong economy, they don't want to underwrite other people's debt and allow their taxpayers to be burdened by bailing out Greece or Spain or Italy or other countries until they are absolutely assured that these countries have legally and constitutionally bound themselves to the requirements that imply a loss of sovereignty, so that they have this external oversight of their spending forever into the future. On the other hand, of course, countries like Spain, Italy, and Greece, Ireland, and the others are A, holding out for better terms, and secondly, are understandably angry that they're being pushed into ever deeper austerity, which is really not working. All it's doing is pushing their economies deeper into a hole, which is actually not reducing their debt, but if anything, increasing their debt, because they're not generating income as their economies are squeezed. So you've left with this very difficult balancing act right now. Where does it go? Well, we don't know, and nobody knows, and I don't think the politicians themselves know. I think they know that they want to end up with a single fiscal entity, a kind of United States of Europe, if you will, where they not only have a single currency and a single interest rate with a single central bank, which is the existing setup, but also a single fiscal body and parliament as well. The problem is getting there. And there are various sort of unpredictable twists and turns that can happen along the way. Of course, all these countries are democracies. And at the end of the day, if any country gets overly fed up with the situation that they find themselves in, they might find that they get an unpredictable government which basically just decides to leave. So we kind of, I think about this, and we've used the analogy of the Chinese experiences in the second half of the 20th century, in terms of thinking about scenarios here. One is what we would call a cultural revolution, where you just suddenly get this epiphany and everyone just decides to give up their differences, give in a little bit, compromise, and agree some form of line which can quickly get to a fiscal union and alleviate many of the market pressures. I have to say we think that's pretty unlikely, without some major forcing mechanism, which I can come back to. The second scenario, which is really, I guess, our central scenario, is what we call the long march, and that is really the status quo, the long, grinding muddle through, where increasingly the ECB, which is the only politically autonomous Euro-wide institution which has the flexibility to act quickly, often is forced in to prevent a crisis, but where the political agreements are actually pretty slow and tortuous, and you get sort of 2 steps forward, 1 step back. And this can carry on really for quite a long time. So I guess those are the different sort of outcomes. Ultimately, a decision will need to be made, because you can't carry on with this muddle through forever, and market pressures will build to an extent where there is a forcing mechanism, and at some point concessions will have to be made if indeed all these countries believe that the cost of the thing breaking apart is bigger than the cost of making the concessions to hold it together, or indeed you get some kind of extreme forcing mechanism through financial markets and perhaps an unpredictable political event and the thing breaks apart. Our guess is that it does stay together, and I think increasingly financial markets are pricing that more as a central theme. And for those of you, I don't know how many people here are involved in financial markets. How many are, just as a matter of interest? Who works in finance or peripherally? Maybe half the people. Look, I think this is an unusual crisis in that it hasn't come out of nothing. It's been well advertised and it's been going on for a long time now. So financial market participants have been able to adjust to these varying probabilities, and in many ways we find that global fund managers, for example, have reduced their exposures to European assets quite dramatically. European managers who are forced to buy things in Europe have minimized the risks by reducing exposure to the things that are most systemically at risk from these events. Spain, banks, and various things like that. So in our view, there's a lot of value now in financial markets, particularly risky assets like equities, because the markets have adjusted to these likely probabilities. But really to be, I think, confident of any decent return for that risk, you really have to take quite a long-term view and be prepared, I think, to take quite a lot of near-term volatility. But for those people who can take a long-term view, I think there are a lot of opportunities in financial markets, and particularly in Europe, where there are now a lot of very undervalued assets, and there are a lot of very, very good assets, lots of very well-run, very good companies selling good products, and many of those are being sold to the areas of the world which are growing most, like emerging economies, China, Brazil, and so on. And so, finish on a slightly more positive note, I think there are very good opportunities in Europe. I think in the end, Europe is bound together, and the costs of it breaking apart are just politically, socially, and economically just too big. And ultimately, I think leaders will be pragmatic and recognise that. And game theory would suggest that the optimum strategy is for everyone to work together, compromise, so that the whole is bigger than the sum of the parts, and I think that will happen. The final thing I would say is that we are living in very stressful, unpredictable times, socially, economically, politically, in all kinds of ways, and we can talk a little bit about that. But if you look at the forecasts that are being made by the World Bank, the United Nations, ourselves, for global economic growth for decades, so I don't mean what's happening this year or next year, but think about the period from 2010 to 2020, because a lot of that is, in the long run, relatively predictable because it's driven a lot by population growth, which is relatively predictable. This decade we're in is actually likely to be the strongest decade of global growth, stronger even than the last one. And people often forget that because they're looking at the very short term, which does seem, and indeed is in many ways, very stressful. So before we get overly gloomy, I think that many of the opportunities for growth and from the technology revolution, which is still ongoing and benefits of which we've yet fully to see, I think there's going to be, hopefully quite a bright future, but it may feel quite difficult getting to that end game, but I think that will be the direction we move into. So I think maybe that's an opportune time maybe to open it up, to take some questions, and they can be as wide-ranging as you like, and maybe other people can answer, because I don't know if I'll be able to answer them all.
Okay. You asserted that there is a moral hazard, a free ride problem, because there must, by definition, be one interest rate, and hence the solution is imposition from the centre to control the misbehaviour in the country. But is that really the case? If one starts to use the no bailout rule, and allow the country to borrow whatever way they were able to borrow, and banks lend to each
Yeah.
as they could one not then allow a country to go bankrupt? And would that not be an alternative scenario for the future to the one that you have suggested
Well,
to roll out?
That is a very good question, and I think what you say makes a great deal of sense. And it may. Sorry, I will repeat that question to the extent. I mean, to summarise, I think the question is: look, there are alternative ways in which this can hold together, where you don't have just a single interest rate. You have countries borrowing at their own interest rate, which is the case now. But countries are allowed to fail and allowed to default, but they still effectively stay in the system. I think that's what you're getting at. Now, I mean, this is quite a complicated topic, and it depends on how involved people are in these discussions and how close they are to the topic. But one of the policy solutions that we've been writing about and kind of recommending, if that's the right word, and we know that it has become increasingly popular amongst the sort of policy Sherpas, the people who are collecting ideas to push up to the politicians, is something akin to what you're saying. So there is a potential solution out there, or semi-solution, which is based on the idea of what's called a redemption bond in Europe, and the kind of basic idea here is that every country raises their own debt up to a limit of 60% of GDP, and the cost of that debt will vary according to the confidence that the markets have in that country, and anything above that, so the historic accumulated debt above 60% of GDP, is backed by effectively a Eurobond. So that means a single European bond or debt backed by joint and several guarantees, which means that effectively it's backed by the last man standing. If one country after another default, then ultimately the one country left is left with the bill. You can see why Germany is a bit resistant to this idea. But the Italians and the French are pushing quite hard for something along these lines. In some ways, it's not quite as worrying for Germany as it sounds, because the quid pro quo is that countries who have levels of debt above 60% have to collateralize that debt. So they have to, at the outset, put assets up, which would then be seized by any country that's left with a bill in the event of a final default. And those assets could be gold reserves, they could be state companies or whatever. And if you think about a country like Italy, for example, it's got huge assets and reserves that it could put up and provide some confidence for that kind of solution, to work. I mean, in practice, there are lots of other complicated twists in that sort of solution, but something along those lines may actually work. And the Germans conceptually quite like this idea because it's similar to the German state model, which is that you do have a central budget, but you have state budgets as well, and states can fail, just as they can actually in the United States. So something of a hybrid solution like that ultimately may be part of the solution.
I heard suggested that an element of the end game is inflation.
Yes.
Do you agree with that? And if so, why? If not, why not? And if so, what kind of time period do you envisage inflation taking off?
Okay, well, that's a really good question. I should have mentioned that. In fact, the issue of inflation is relevant generally, not just to Europe, because we are in such unusual and unprecedented times that, as you know, governments are having to resort to quite creative ways of trying to support growth, and in various different forms that involves, what we elegantly call quantitative easing, which is basically printing money in one form or another. Now, theory suggests that, inflation is ultimately a monetary phenomenon. If you print money, if you create it and it circulates, that will create inflation. But a lot of what is going on at the moment is just one huge global live experiment. It's never been done before. Policymakers only really know